In a recent video, we explored trickle-down economics, the idea that if you support investors and high earners, it'll eventually benefit everyone else as well. But today, we're flipping the lens. What if, instead of starting at the top, we start at the bottom? What if economic policies puts more money directly into the hands of everyday people, the workers, the spenders, the backbone of the economy? That's the core idea behind what some economists call trickle-up economics, or more formally, demand-side economics. The theory goes like this. When consumers have more income and financial stability, they spend more. That increased demand helps businesses to grow, invest, and hire, which then strengthens the economy from the ground up. It's a model that has gained renewed interest in the last 2 decades, once after the 2008 financial crisis and then again during the COVID pandemic. So in this video, we'll explore how trickle-up economics actually works, where it's shown promise, and where it faces challenges. And of course, we'll ask the big question, can economic growth start from the bottom, and under which circumstances does it work best? At its heart, trickle-up economics is based on a very simple idea. The economy grows stronger when the broad base of society has more money to spend. Unlike supply-side theory, which starts with investors and producers, trickle-up economics starts with consumers and workers, those who create the demand that keeps businesses running. It argues that boosting purchasing power, especially for lower and middle-income households, leads to higher consumer spending, which then encourages businesses to expand, invest, and hire. Policies typically associated with trickle-up economics include raising the minimum wage, expanding social safety nets like unemployment benefits or food assistance, tax relief for low and middle income earners, infrastructure spending that creates middle class jobs, and public investment in education and skills development. Those measures aim to directly raise incomes for those who are more likely to spend rather than save, which increases demand for everyday goods and services. And that's important because in many developed countries, like the US for example, consumer spending accounts for roughly 70% of GDP. So if consumers slow down, so does the whole machine. But here's what's often left out of the conversation. Trickle-up economics works best under certain conditions and is not a one-size-fits-all solution. Also, trickle-up economics isn't about handing out cash for its own sake. It's about fueling demand in a way that stimulates private sector activity. But just like trickle-down, it's not a magic formula. If applied in the wrong conditions, say during supply constraints or when government debt is already overstretched, it can lead to inflation, inefficient spending, or even weakened work incentives. So now that we've unpacked the basic idea, let's jump into a real-world historical example where this idea was tested on a big scale. One of the most iconic real-world examples of demand-side economics is the New Deal. It was launched by President Roosevelt in the depth of the Great Depression. When Roosevelt took office in 1933, the US economy was in free fall. Unemployment was near 25%, banks were collapsing, and demand for goods and services had virtually evaporated. It was a full-blown crisis, and supply-side solutions like tax cuts weren't enough to address the scale of the collapse. So Roosevelt took a different approach, stimulating demand directly by giving money and jobs to ordinary Americans, even if it meant temporarily expanding government intervention in ways the country had never seen before. The New Deal included a range of programs that put people back to work and money back into circulation. Public works agencies like the Works Progress Administration and Civilian Conservation Corps hired millions to build roads, bridges, schools, and parks. The Social Security Act laid the foundation for old age pensions and unemployment insurance. Labor protections, banking reforms, and rural electrification programs helped stabilize household income and spending, and minimum wage laws were introduced to ensure that jobs paid enough to support consumption. The idea was clear. Restart the economic engine from the demand side by restoring purchasing power to the people most likely to spend it. So from 1933 to 1941, the US economy grew at an average of around 8% per year. Unemployment dropped from around 25% to under 10% even before World War II spending kicked in. The physical infrastructure built during this period supported economic productivity for decades, and perhaps most importantly, the middle class began to expand, laying the groundwork for the post-war boom. But it wasn't all smooth sailing. Critics point out that recovery was uneven, and the economy dipped again in 1937 when stimulus was withdrawn too soon. Some New Deal programs were also inefficient or politically motivated, and long-term dependence on government jobs raised questions about sustainability and market distortion. So the New Deal didn't prove that trickle-up is always the answer, but it did demonstrate that in a deep demand-side crisis, putting money and work directly into people's hands can jumpstart growth and restore confidence. It also showed the importance of timing. When private sector investment dries up, targeted public demand acts as a bridge, not a permanent replacement, but a temporary stabilizer. So the New Deal took place nearly a century ago. But during the COVID pandemic, we saw some of the same ideas come back around. Direct payments, job protection, government spending, all applied in a modern context. So what did we learn this time? Fast forward nearly a century from the New Deal and the world faced another crisis, the COVID-19 pandemic. Businesses shut down, millions lost jobs, and consumer spending collapsed overnight. In response, governments around the world, and especially in the US, leaned hard to direct cash transfers to households as a way to stabilize the economy. These were not traditional stimulus tools like tax cuts or infrastructure projects. This was pure demand-side intervention, putting money directly into people's bank accounts and hoping it would keep the system afloat. The US issued 3 major rounds of stimulus checks: $1,200 in spring 2020, $600 in December 2020, and $1,400 in March 2021. These payments were designed to help people cover their essential expenses, but also keep consumer spending alive, which is critical in an economy where consumption makes up 70% of GDP. The short-term results were significant. Retail sales spiked, jumping nearly 10% in March 2021 alone after the third round of payments. Food insecurity dropped sharply following each round, especially among lower-income households. Small business revenue stabilized, especially in sectors like food, service, and retail, and despite fear of mass insolvency, personal bankruptcies actually fell during the pandemic. Studies showed that people with less than $500 in their bank account spent half of the stimulus checks within only 10 days of receiving, and this immediate spending helped keep businesses afloat during the crisis. But this came with real consequences. While stimulus helped prevent economic collapse, it also contributed to inflationary pressure in 2021 and 2022. With millions of people receiving large cash infusions while supply chains were still disrupted, prices began to rise quickly in key categories like cars, food, housing, and energy. Economists now widely agree that scale and timing of the stimulus were part of the inflation puzzle, and since wealthier households received checks too, a large portion of the funds were saved or invested, which diluted the impact on spending and made the whole policy less efficient. Critics argue that more targeted aid, aimed only at low-income or unemployed workers, could have delivered most of the benefit without the inflationary risks. The stimulus checks were a textbook example of trickle-up economics in a crisis, with targeted spending aimed at those most likely to circulate money quickly. And it largely worked because conditions were right. There was massive slack in the economy, interest rates were near zero, supply chains hadn't fully collapsed yet, and the goal wasn't long-term transformation, it was short-term stabilization. But it also exposed the limits of trickle-up economics. If too much money chases too few goods, or if supply can't keep up with surging demand, inflation becomes a real concern. So stimulus checks are a great example of what demand-side policies can do during a crisis, but what happens when these policies aren't just one-time responses, but part of long-term strategies, like raising the minimum wage, for example? Let's explore that next. One of the most widely used policies tied to trickle-up economics is raising the minimum wage. The logic is simple: when low-income workers earn more, they spend more, and that fuels the economy. And that spending fuels demand across the economy, helping businesses grow. This demand-side strategy aims to stimulate growth from the bottom up, not by giving money away, but by ensuring work pays enough to support basic consumption. But here's where theory and reality must meet. Because in economics, the idea is not that minimum wages are inherently bad. It's that a wage that is set above the equilibrium wage, where supply and demand meet, can create distortions. Because if it's set too high, it can cause job losses, reduced hours, or even business closures. So the question isn't whether we should have a minimum wage, almost every country already does. The question is, how far can we raise it before the side effects outweigh the benefits? Let's start with what we have learned from real-world cases. In Seattle, which raised its minimum wage to $15 by 2021, multiple studies found no evidence of large-scale job losses. Workers in low-wage industries earned more overall, and turnover fell. In New Jersey, when the minimum wage was raised in the fast food sector in the 1990s, employment stayed steady, even compared to neighboring Pennsylvania, which hadn't raised its rate. A 2021 study of 138 wage hikes in the US found that the overall effect on employment was statistically negligible, especially when hikes were modest and gradual, and businesses often offset costs through small price increases, improved productivity, or lower recruitment costs from reduced turnover. In these contexts, usually large urban economies with high living costs, moderate wage increases didn't just raise incomes, they boosted local consumption, which supported business revenue and employment. But unfortunately, not every case has been this smooth. In Puerto Rico, the US federal minimum wage was applied in the mid-20th century, despite the island's much lower cost of living and productivity levels. Over time, the high minimum wage contributed to a decline in employment, especially among younger, less skilled workers. In South Africa, when a national minimum wage of 20 rand per hour was introduced in 2019, researchers found that it did increase wages for covered workers, but also reduced total hours worked, particularly in agriculture and domestic work. In California, where multiple cities raised minimums above $15 per hour, some small businesses, especially in restaurants and childcare, reported closing locations, automating tasks, or cutting shifts to stay afloat. And even in Seattle, one study found that while wages rose, some workers saw reduced hours, which blunted the total earnings gain for certain groups. These examples don't mean raising the minimum wage is a mistake, but they show that context matters deeply. A wage that works in New York City might be too high for small towns in Mississippi, and if increases outpace productivity, the result is not higher living standards, it's hiring freezes, automation, or outsourcing. So minimum wage policy is one of the clearest cases where theory, setting wages above equilibrium, creates unemployment. In practice, governments raise minimums incrementally, avoiding steep jumps that would create a major fallout. So minimum wages can be a powerful tool, but only when set carefully. So now let's zoom out and take a look at countries that built entire economic systems around high wages, generous safety nets, and strong demand. How do they manage to pull it off, and what lessons can we learn? When people talk about countries where the economy seems to work for everyone, they often bring up countries like Sweden, Denmark, Norway, or Finland, the so-called Nordic countries. These places are known for having high taxes, strong social safety nets, and well-paid workers. And yet they somehow also have thriving businesses, low poverty, and one of the highest life satisfaction rates in the world. So how does that work? And does it mean trickle-up economics works when done right? At first glance, the Nordic countries look like a clear success story for the idea of starting growth from the bottom. Wages are high, healthcare and education are free or heavily subsidized, and people generally don't worry about falling into poverty if they lose their job or get sick. That kind of financial security means people can keep spending even in hard times, which helps keep the economy running. But here's what makes this model interesting. It doesn't focus on giving people more money. It makes sure that money keeps moving through the system in productive ways. For example, nearly everyone pays taxes, not just the wealthy. That helps fund universal programs that benefit everyone, so there's broad support for the system. Workers are protected, but at the same time, businesses aren't weighed down by excessive red tape. If a company needs to downsize, it can, but the government helps the workers retain and find new jobs quickly. Another key ingredient is trust. People trust their institutions, and corruption levels are very low. That's a big reason why these systems stay efficient and don't turn into bloated bureaucracies. And since things like education and healthcare don't eat up income like they do in other countries, people have more flexibility to take risks like starting a business or changing careers. But of course, this approach comes with trade-offs. Because of higher taxes, people take home less money than they would in lower tax countries like the US, for example, and some argue that higher taxes reduce the incentive to work harder or innovate. And while services are generous, they can become very costly if not managed carefully. These systems also tend to work better in smaller and more cohesive societies where it's easier to build consensus around shared goals. So no, these countries are not a trickle-up utopia. It's a model that works because all the pieces fit together. What we can take away from the Nordic systems isn't that every country should copy their policies, it's that bottom-up policies can work, but only when combined with strong institutions, responsible budgeting, and smart public investment. So it's not about choosing between trickle-down and trickle-up, it's about building a system where both people and businesses have what they need to grow together. So far, we've looked at ways money moves through economy, from wages to stimulus to national models. But there's still one question we haven't answered fully. Why does it even matter who receives the money in the first place? This brings us to a core idea in macroeconomics called the multiplier effect. It's a way of measuring how much total economic activity is created when $1 is spent. And it helps explain why giving money to different groups produces very different results. Let's say the government gives someone $100. If that person goes out and spends it at a grocery store, for example, that $100 becomes income for the store. The store owner might then use part of it to pay an employee, who might use it to pay rent, and so on. Each time the money changes hands, part of it is spent again. This cycle keeps going, though with smaller and smaller amounts each time. That's the multiplier. It measures how many times money is being re-spent and how much economic activity it creates. In economics, it's modeled like a chain reaction, but not all dollars move through the system the same way. If that $100 goes to someone living paycheck to paycheck, they will almost certainly spend it right away. This fuels businesses, jobs, and more spending. But if it goes to someone who's already financially comfortable, they're more likely to spend or invest it, which does not create the same short-term boost. That's not a bad thing. In fact, saving and investing are critical for long-term growth because that money might help fund a startup, build a factory, or boost the stock market. But those benefits take time, and also they're harder to predict or measure directly. A dollar spent at a restaurant creates demand today. A dollar invested in a tech company might pay off in 5 years or not at all. So economists tend to focus on short-term multipliers when evaluating things like stimulus programs or wage policies, and what they consistently find is that money given to lower-income households tends to have a multiplier of 1.2 to 1.5. Food assistance or unemployment benefits often score even higher, sometimes over 1.7. But tax cuts for high-income households have much smaller short-term multipliers, usually around 0.3 to 0.5, because more of that money gets saved. But again, it's not that giving money to wealthy people is bad, it's just that the economic impact looks very different. If you need to stimulate money quickly, say during a recession, that's why economists often support direct spending or wage increases during economic slowdowns, because the return on each dollar is faster and more predictable. Meanwhile, tax cuts or investment incentives might still work, but often need time, stability, and the right conditions to pay off. So both can have value, but the key is knowing which tool to use when. So after digging into trickle-down and trickle-up economics, what have we actually learned? First, the obvious. Neither model is a silver bullet. Trickle-down can work in certain conditions: when businesses have room to expand, when tax cuts lead to real investment, and when those gains eventually reach workers and consumers. And trickle-up policies can absolutely grow the economy, especially when they put money in the hands of people who'll spend it quickly and locally. But here's the deeper insight. Economies don't grow because money flows in one direction, but because it flows at all. The real challenge isn't choosing between top or bottom, it's making sure money keeps circulating productively, whether it's coming from wages, tax cuts, business investment, or public spending. We also saw that context matters enormously. A minimum wage that works in New York might not work in rural Alabama. A stimulus check might help save the economy in a crisis, but cause inflation in a recovery. A tax cut might lead to long-term investment, or just fuel a bubble. The trick isn't ideology, it's timing, calibration, and knowing the trade-offs. And if there's one idea to take away from this entire discussion, it's this. Strong economies aren't built by choosing sides. They're built by designing systems that empower people to spend, businesses to grow, and capital to flow in ways that actually create value. So next time you hear a politician say tax cuts to grow the economy or raise wages to fix inequality, you'll know the right answer isn't just yes or no, it's under which conditions, for how long, and what are the trade-offs. So if this video helped you understand economic policies a bit more, consider liking and subscribing for more videos like this. So thank you very much for watching, and I hope to see you in the next one.